In October 2025, China's top chipmaker, SMIC, Semiconductor Manufacturing International Corp., hit a market capitalization of roughly $92 billion, about 175% higher than a year prior. This staggering surge to almost 730 billion yuan in market value far outpaced the broader market and turned SMIC into one of the world's most valuable semiconductor firms. The stock's meteoric rise has prompted a pressing question. Does this valuation reflect real fundamental progress, or simply a re-rating based on policy-driven optimism? To answer that, let's break down SMIC's 2025 story in 5 acts, from the raw numbers to the catalysts, the technical reality, the market's optimism, and finally the risks that lie beneath the rally. First, the basics. SMIC's share price has soared over the past year, lifting its market cap to about $92 billion by late 2025. For context, that makes SMIC the second largest pure-play foundry by value, behind only TSMC, and roughly 5 times the size of US-based global foundries, around $19 billion. The stock is up well over 150% year-on-year, reflecting a huge re-rating by investors. Yet, SMIC's financial scale remains modest next to its valuation. In 2024, SMIC's full-year revenue was about 57.8 billion Chinese yuan, approximately $7.95 billion US dollars, up a strong 27.7% from 2023. Net profit, however, was only 3.7 billion Chinese yuan, approximately $0.5 billion US dollars, and in fact fell 23% year-on-year amid US export controls and reduced investment gains. That put SMIC's net profit margin around 6%, a fraction of industry leader TSMC's approximately 40% net margin in 2024. Drilling into 2025's interim results shows a mixed picture of fast growth on a low base. In the first quarter of 2025, SMIC's revenue jumped 28.4% to $2.2 billion, just shy of analyst estimates, and profit surged 161.9% year-on-year to $188 million. That rebound from a weak prior year quarter underscores how much earnings had dipped in early 2024. By the first half of 2025, revenue reached $4.47 billion, up 23.4% year-on-year. SMIC even notched record-high quarterly sales in late 2024 and early 2025. However, profits remain thin relative to the company's new market cap. Trailing 12-month earnings are only a few $100 million, implying a triple-digit price-to-earnings ratio. In other words, the stock's valuation is being driven by expected future gains and strategic importance rather than current profits. SMIC's gross profit margin in 2024 was about 18.6%, a steep drop from 30+% in the years before US sanctions, and far below TSMC's approximately 56% gross margin that same year. Even with some margin recovery to approximately 22% in late 2024, SMIC is operating with much lower profitability than its Taiwanese rival. These numbers paint a picture of a company whose valuation has raced ahead of its current financial reality, setting the stage for the forces that investors believe will bridge that gap. So, what fueled investors' exuberance for SMIC in 2025? 3 main catalysts stand out: state capital, a Huawei-led wave of domestic substitution, and improved fab utilization driving revenue growth. 1. Massive state capital infusion. Beijing has made semiconductor self-sufficiency a national priority, and it's backing SMIC with serious money. In mid-2024, China's so-called Big Fund, the National Integrated Circuit Industry Investment Fund, raised a gargantuan 344 billion yuan, about $47 billion, for its Phase 3 semiconductor fund. This was the largest government-backed funding round to date for the chip sector, aimed at everything from fab equipment to foundries. As the flagship foundry, SMIC stands to benefit hugely from this war chest. The company was already the single biggest recipient of state chip subsidies in recent years, In 2022, SMIC received roughly 1.95 billion yuan, $280 million in government subsidies, more than any other Chinese chip firm. Now, policy has shifted to make funding even easier. A 2023 policy report indicated SMIC, along with Huawei and local equipment makers, would get access to additional government funding without needing to hit previous performance targets. In short, the state is opening the spigots. SMIC's capital expenditures have accordingly surged over $7.3 billion in 2023 and a planned $7.5 billion this year to expand capacity, much of it enabled by state-backed capital and loans. Investors see this robust state support as a guarantee that SMIC can keep investing and growing, even if near-term profits are thin. 2. Huawei-led domestic substitution. The second catalyst is Huawei's pivot to SMIC and the broader Chinese tech ecosystem's buy domestic movement after US sanctions. In late 2023, Huawei stunned observers by launching the Mate 60 Pro smartphone, torn down to reveal a Kirin 9000S chip fabbed by SMIC on a 7nm class process. Tech Insight's analysis confirmed SMIC's N+2 7nm technology was used, a made-in-China milestone achieved despite the ban on extreme ultraviolet EUV lithography. This was more than just a technical feat. It marked Huawei's return to the high-end smartphone arena using a domestic foundry. The Mate 60's surprise debut sparked national pride and a surge in confidence that Chinese fabs could start replacing TSMC/Samsung for homegrown chips. Crucially, Huawei, which had been forced off TSMC's 5nm lines by US export controls in 2020, began redirecting its chip orders to SMIC. Beyond smartphones, Huawei is also working with SMIC on chips for telecom and AI. For example, Huawei's new AI accelerator, Ascend 910B, is being produced at SMIC on a 14nm process, and reports suggest an even more advanced Ascend 910C on SMIC's N+2 node is in the pipeline for 2025. This captive demand from China's biggest telecom and device maker is a huge tailwind. It not only fills SMIC's advanced capacity, it also signals to other Chinese companies that SMIC's technology is viable. Since Huawei's pivot, other domestic chip designers and OEMs have stepped up engagement with SMIC for fear of being cut off from foreign fabs. The result? SMIC's order books swelled with local business in 2024 to 2025, replacing, at least partially, the lost foreign customer orders from firms wary of US sanctions. 3. Full fabs and revenue growth. Thanks to this surge in domestic demand, SMIC's fab utilization and output hit record highs. During the global chip downturn of 2022 to 2023, many chip fabs worldwide saw slackening utilization. The industry average fab utilization fell to approximately 70% in 2023. SMIC bucked that trend. By Q3 2024, SMIC executives reported their fabs were running at over 90% capacity utilization, notably stronger than the industry norm. For the full year, 2024, SMIC averaged about 85.6% capacity utilization, which the company pointed out was significantly higher than peers. In practical terms, that means SMIC was producing wafers nearly as fast as it could across its production lines. This was driven in large part by domestic electronics and appliance demand. In 2024, Chinese consumer stimulus measures boosted sales of TVs, smartphones, and other gadgets that rely on SMIC's chips, keeping its mature node fabs busy. The high utilization translated into strong top-line growth. SMIC's wafer shipments hit a record 8.02 million 8-inch equivalent wafers in 2024, up approximately 37% year-over-year, and revenue jumped approximately 30% in its core foundry business. By the first half of 2025, revenue was still rising at 23 to 25% year-on-year. In fact, Q4 2024 saw revenue up 31.5% year-over-year to $2.2 billion, and SMIC climbed to number 3 in global foundry market share with about 5.5% of the market, leapfrogging some Taiwanese rivals. Investors have taken notice of these solid growth metrics, believing that robust fab utilization and state-backed expansion could continue to drive 20 to 30% annual revenue gains, even if the wider chip market slows. In short, SMIC's numbers began trending up in 2024/25, and markets extrapolated those trends sharply forward. Amid the market euphoria, it's important to acknowledge the technical reality of where SMIC stands. The company has made notable strides under sanction constraints, but it still faces significant technology gaps and efficiency disadvantages versus leading-edge peers. Advanced nodes. Under constraints, SMIC's most advanced process in production is often referred to as 7 nanometers N+2, first seen in that Huawei Kirin 9000S chip. While a breakthrough for China, this node is roughly equivalent to TSMC's 2018-era 7 nanometer tech in density, and SMIC can only manufacture it in limited quantities. Yields on these advanced chips are very low. According to Reuters sources, Huawei's new AI processor, Ascend 910C, made on SMIC's N+2 node, is achieving only about 20% yield, meaning 4 out of 5 chips on a wafer are defective. Even Huawei's slightly older 910B chip, on a less advanced node, had around 50% yield, forcing Huawei to slash production targets and delay orders. For context, leading foundries aim for 90% plus yield on a mature process, and even new cutting-edge nodes typically reach 70% plus yield to be commercially viable. SMIC is nowhere near that for its 7 nanometer class products. This severely limits the volume and profitability of its advanced offerings. Huawei's chip projects with SMIC have been as much about proof of concept and strategic necessity as about efficient production. The fundamental reason is SMIC's lack of extreme ultraviolet EUV lithography. Since 2019/2020, the US has successfully barred ASML, the Dutch maker of EUV tools, from exporting any EUV scanners to China. EUV is essential for printing the tiny features of modern 7 nanometer, 5 nanometer, 3 nanometer chips with relative efficiency. Without it, SMIC has had to resort to older deep ultraviolet DUV lithography with multiple patterning steps, a much more cumbersome process. It can be done, but it's expensive and yield draining. A recent TrendForce report noted that SMIC's forthcoming 5 nanometer process, N+3, if realized using DUV multi-patterning, could have wafer costs up to 50% higher than TSMC's 5 nanometer due to lower yields and more process steps. In fact, SMIC's 5 nanometer equivalent yields are reportedly only 1/3 of TSMC's on comparable technology. This huge gap means SMIC can't currently compete on advanced node cost or volume. Its 7 nanometer/5 nanometer wafers are largely for strategic customers like Huawei, not general market sales. It's also worth noting that advanced chips remain a tiny slice of SMIC's revenue. The company has never explicitly confirmed it makes Huawei's 7 nanometer chips, officially calling it customer confidential, and it emphasizes that mature nodes, 28 nanometers and above, still make up the bulk of sales. Indeed, over 75% of SMIC's capacity is on 45 nanometer and older nodes, and even the advanced 28 nanometer and 14 nanometer lines are fully occupied by things like image sensors, Wi-Fi chips, and microcontrollers for appliances. Management said that chips like those in Huawei's smartphones represent only a marginal portion of revenue. So the soaring stock price isn't because SMIC suddenly became an advanced node powerhouse. It's largely because of expectations that it might catch up in the future, or at least secure a domestic market for those chips. Efficiency and margin gaps. SMIC's technology gap manifests in its financial efficiency. As mentioned, gross margins have tumbled to the high teens, reflecting higher costs and lower yields. By contrast, TSMC's gross margin has held around 55 to 60% in recent years, thanks to its technology leadership and economies of scale. SMIC's operating costs have ballooned as it pours money into R&D, nearly 10% of revenue on R&D in 2024, and deals with the inefficiencies of sanction workarounds. For example, SMIC's depreciation costs are rising approximately 20% annually with its heavy capex, putting pressure on 2025 profits. The net result? In 2024, SMIC earned just $107 million net income in Q4 and about $500 million for the full year, whereas TSMC made roughly $11 billion net per quarter in 2024. The disparity is enormous. SMIC is valued at approximately 1/5 of TSMC's market cap, but produces less than 1/30 of TSMC's annual profit. This underscores that SMIC's current valuation is not about current earnings power, it's about future potential and strategic importance. Technical progress and geopolitical backdrop. To be sure, SMIC's recent technical progress is real. The fact that a 7nm Kirin 9000S chip exists and works inside a 5G smartphone is a testament to the skill of SMIC's engineers under sanctions. Discovering a Kirin chip using SMIC's 7nm process in the new Huawei phone demonstrates the technical progress China's semiconductor industry has made without EUV, said Dan Hutchison, Vice Chair of Tech Insights, adding that the difficulty of this achievement also shows the resilience of China's chip sector. But Hutchison also issued a warning. This achievement is a great geopolitical challenge to the countries that tried to restrict China's tech, and the result may likely be even greater restrictions than what exist today. In other words, each tech advance by SMIC could trigger a tightening of export controls, making the next advance even harder. This dynamic is a key part of SMIC's reality. It is progressing, but under a tightening gauntlet of restrictions that keep it a step or two behind the cutting edge. All told, the tech reality is that SMIC is still playing catch-up, with older tools, lower yields, and thinner margins, even as it carves out a niche serving China's urgent needs. Why then are investors piling into SMIC's stock despite those headwinds? The answer lies in market optimism around the strategic narrative. SMIC is viewed as a linchpin of China's tech self-reliance, with massive option value if it succeeds, and substantial safety nets due to policy support. In essence, the market is valuing SMIC less like a traditional chip company and more like a national champion startup in a critical industry. Betting on self-reliance. Investors are effectively betting that China's drive for semiconductor independence will secure SMIC a guaranteed market and steady support. This gives SMIC a kind of embedded option on future growth. If geopolitical tensions persist, Chinese electronics and AI companies will have to use domestic foundries, and SMIC, as the most advanced in country, stands to benefit enormously. The stock's rise reflects the belief that SMIC's addressable market within China is about to expand dramatically as imports are substituted. There's also a perception that SMIC's survival and success are government priorities, which lowers the risk of worst-case scenarios. The company's access to capital, customers, even talent, through state-guided programs, is bolstering confidence that it can gradually close the technology gap. In other words, the market is valuing not what SMIC is, but what it could become under ideal conditions and strong state tailwinds. This sentiment was summed up by Stuart Randall, an analyst at Intralink, who noted that a key driver of the recent rally is the idea that many new chip demand areas, like AI, don't necessarily need the absolute bleeding-edge processes. Investors are betting that AI development might not require the most advanced chips, Randall explains, potentially benefiting domestic chipmakers such as SMIC. If much of the AI and specialty chip demand can be served by 14nm, 28nm, or chiplet architectures on older nodes, SMIC doesn't need to be on 3nm to cash in. It can dominate the mid-range needs of a very large market. Indeed, Chinese companies rolling out AI services are already buying lots of mature node chips, AI accelerators, networking chips, power management, etc. And SMIC can fill part of that demand without matching TSMC's tech. The idea of good enough chips for AI has given investors hope that SMIC can ride the AI wave domestically, even if it lags on the leading edge. Capital chasing the theme. The optimism is also fueled by a rush of capital into anything related to localization of tech supply chains. Both Chinese and international investors have been policy-themed trading, meaning they invest in sectors the Chinese government is prioritizing. Semiconductors are priority number one. For example, in late 2023, China launched a new CSI semiconductor index to highlight chip companies and updated its blue chip indices to give greater weight to strategic industries like chips. SMIC's A-share Shanghai listing was included, prompting more domestic funds to buy in. Meanwhile, global emerging market funds and tech funds, wary of missing out on China's big chip push, have also increased exposure to SMIC. This influx of capital has a momentum of its own. As SMIC's price climbed, it drew in trend-following investors, amplifying the move. We've also seen concrete bullish calls from major institutions that added fuel to the fire. In October 2025, Morgan Stanley upgraded SMIC's stock, raising its target price from 40 Hong Kong dollars to 80 Hong Kong dollars, essentially doubling its valuation outlook. The rationale? Morgan Stanley's analysts cited China's rapid adoption of AI and heavy state support for local AI chips as drivers that will significantly boost domestic demand for advanced node wafer foundry over the next 2 years. In other words, they expect SMIC's nascent 7-nanometer capacity to be in high demand due to a policy-fueled boom in Chinese AI processors. This kind of endorsement from a global investment bank lent credibility to the bullish case and likely brought in more institutional buyers. Another factor, reports that SMIC is testing domestic lithography equipment, such as a homegrown immersion DUV scanner capable of 28 nanometers from a Chinese supplier, created excitement that China's ecosystem might solve SMIC's equipment bottlenecks. Each positive rumor or news bite, no matter how incremental, has tended to send SMIC's shares higher, as it reinforces the narrative of unstoppable progress towards self-sufficiency. Underpinning all of this is a quietly assertive market sentiment that SMIC is too important to fail. Investors see a company that, while currently earnings challenged, has an almost unlimited backstop from the Chinese state and a captive customer base being built by policy. In finance terms, some see it as owning a long-term call option on China's semiconductor future. If SMIC even partially closes the technology gap in coming years, the payoff could be huge, given China's enormous chip consumption market. And if it struggles, the thinking goes, the state will still prop it up and ensure a baseline of business. This asymmetry, big upside if things go right, limited downside due to state support, is very attractive to speculative capital. It's a key reason why SMIC's market cap has swollen to levels disconnected from today's earnings. Investors are pricing in the potential and the policy guarantees, not the present reality. No evaluation of SMIC's surge would be complete without examining the risks and caveats. Beneath the optimistic narrative, there are formidable challenges that could undermine SMIC's lofty valuation. Here are the main risks investors and analysts are eyeing: export controls tightening. The same geopolitical forces that helped channel business to SMIC, i.e., US sanctions on Huawei and Chinese chips, are also a persistent threat. US export controls on semiconductor technology have escalated in waves, and 2025 is likely to bring more. Washington has already barred SMIC from obtaining EUV tools, and more recently, even restricted certain advanced DUV machines and chip design software. In late 2024, the US Commerce Department under the outgoing Biden administration broadened rules to block China's access to cutting-edge chips and equipment. And with the return of a more hawkish US administration in 2025, further curbs are anticipated. In fact, President Trump has signaled even tougher tech trade policies. This could impact SMIC in multiple ways. It might become impossible to import future generations of lithography tools, etchers, or metrology equipment, even for 14 nanometers and above. The US is also scrutinizing SMIC's role in Huawei's chip production. TSMC reportedly notified US officials that one of its 7-nanometer chips turned up in Huawei's new AI system, prompting US authorities to plug loopholes, banning even third-party chips that might end up with Huawei. SMIC itself has been on the US Entity List since 2020, meaning US suppliers need licenses to sell to it, and those licenses can be tightened. The bottom line is that SMIC's technological progress remains at the mercy of geopolitics. Any additional sanctions could slow its development of newer nodes or raise its costs further. Dan Hutchison's observation that SMIC's recent 7-nanometer breakthrough may invite even greater restrictions seems apt. SMIC's every step forward could trigger a response that makes the next step harder. Investors wagering on SMIC are thus inherently also wagering on China's ability to circumvent or endure a sustained tech blockade. That's a risk not fully captured in the rosy forecasts. Quality of earnings and over-reliance on state support. Another concern is that a significant portion of SMIC's profitability is due to government subsidies, tax breaks, and below-market financing, rather than organic operational excellence. The company's financial reports show hundreds of millions of dollars in other income and gains, much of which analysts attribute to state grants. For example, local governments reimbursing part of R&D expenses or giving rebates for purchasing domestic equipment. As noted, 1.95 billion yen of direct subsidies in 2022 went to SMIC. Such support very likely continued in 2023 to 2025, though SMIC doesn't always fully itemize it publicly. If we strip these out, SMIC's true underlying profit would be even smaller or possibly negative in some quarters. This raises the question, how sustainable are SMIC's profits if the government ever dialed back support? Right now, Beijing shows no intent to pull back. If anything, it's increasing support. But investors have to assume continued subsidies, which is a form of reliance on policy. There's also the issue of demand quality. Some of SMIC's revenue growth has been driven by one-off demand boosts, like consumer electronics stimulus in China, and inventory pull forward, customers rushing orders before potential new US rules. SMIC's co-CEO Zhao Haijun warned that some orders in early 2025 were pulled forward from future demand, and that after digesting this batch, later periods could see a drop-off. If China's economy slows, or if government-fueled demand, say for local government surveillance chips, etc., saturates, SMIC could face a sales slowdown. In short, a lot of SMIC's recent performance is policy-propped. If those props weaken, the company will need genuine competitive strength to compensate, and it's not there yet. Customer concentration and advanced node dependence on Huawei. SMIC's big rally was predicated on the idea that it has an inside track to supply China's tech giants. That's true. Huawei, for one, has few other places to go for advanced chips. But this also means SMIC is now highly dependent on a small number of politically exposed customers. If, hypothetically, Huawei's smartphone sales falter or its chip designs hit a snag, SMIC's cutting-edge capacity could go underutilized. Remember, SMIC's N+27 nanometer line at its Beijing fab, known as SN1, is believed to be largely booked by HiSilicon, Huawei's chip unit. There aren't many other Chinese companies that currently need 7-nanometer chips in volume, so SMIC built it and Huawei came. If for any reason Huawei cannot continue to fill that fab, due to sanctions choking its own supply chain or a strategic shift, SMIC can't easily replace that business. Moreover, Huawei is not just any customer, it's a sanctioned entity itself and carries its own set of risks. SMIC has to walk a tightrope to avoid triggering secondary sanctions for helping Huawei in ways that violate US rules. Thus far, SMIC's approach, officially not confirming any Huawei 7-nanometer production, is to stay low-key. But the dependency is there. More broadly, other Chinese fabless firms, like Alibaba's T-Head or Baidu's AI chip unit, are still early in developing advanced chips. They may ramp up orders to SMIC, but that will take time. In the interim, SMIC's advanced node utilization is essentially a one-customer story, which adds volatility. If that one customer sneezes, SMIC's much-hyped advanced business could catch a cold. Global competition and oversupply risks. While SMIC is insulated within China to a degree, it's not entirely without competition or cyclicality. Domestically, there are other foundries, like Hua Hong Semiconductor, which focuses on 55 nanometers/40 nanometers and now 28 nanometers, also expanding capacity. Regionally, if US export rules are slightly relaxed, or if Chinese companies manage to source from TSMC via loopholes, SMIC could lose some business. Perhaps the more immediate risk is oversupply in mature nodes. SMIC's core revenue still comes from mature process chips, 28 nanometers, 40 nanometers, 65 nanometers, etc., used in things like display drivers, power ICs, sensors, and commodity MCUs. A lot of capacity for those legacy nodes has been added in China and elsewhere over the last 2 years of chip shortage. Now, as the shortage turns to surplus, there's concern that by late 2025, the market for mature node chips will swing into oversupply. SMIC itself flagged this risk. In an earnings call, co-CEO Zhao warned of excess capacity and a potential price war in H2 2025 for mature chips, saying new domestic fab expansions, often state-funded, could lead to intensified price competition as manufacturers compete for orders. If prices for 40 nanometer and 28 nanometer wafers drop, that directly hits SMIC's margins. We've already seen some signs. Reports in late 2024 indicated SMIC and Hua Hong were offering up to 20 to 40% discounts to win orders in certain legacy nodes, pressuring Taiwanese rivals. While that helps utilization, it hurts profit per wafer. The risk is that SMIC, to maintain market share and fab load, will engage in a race to the bottom on pricing in legacy businesses. That's great for customers and for China's self-sufficiency goals, cheaper local chips, but not great for SMIC's shareholder returns. Finally, a meta risk, market sentiment itself. The stock's run-up means a lot of good news is already priced in. Any stumble, be it an earnings miss, a delay in technology roadmap, or adverse news, e.g., a high-profile executive departure or a new US blacklist move, could sour sentiment quickly. We saw hints of this volatility. For instance, when SMIC's Q2 2025 profit came in below expectations, profit fell approximately 19.5% year-over-year that quarter. The stock wobbled as investors realized the recovery path is not straight up. With a premium valuation, SMIC is under pressure to execute nearly perfectly in a very imperfect world.